Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we are looking at Ondas.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we really get into the weeds today, we want to mention the special 14-day trial link below in the description for StockOracle.
Right, StockOracle. It is an AI-aided stock research platform.
And just a quick disclaimer, that is an affiliate link, so the channel may earn a commission at no extra cost to you if you use it.
Exactly. And, it is really important to remember that StockOracle's AI insights and valuation estimates, well, they can be incomplete or wrong.
Definitely. You always have to verify important facts for yourself. It is not financial advice.
Right. It is not a trading signal service or, real-time market data. Just a tool to help you build context.
Exactly. So let's get into that context for Ondas, trading under the ticker ONDS.
Yeah. So imagine a company that grows its top-line revenue by, nearly 700% in a single year.
Which is just an astronomical number.
It is. And they are securing these massive contracts with the U.S. Army, right? But at the exact same time, they somehow managed to wipe out 80% of your ownership stake.
Yeah, that is the central paradox we are unpacking today. It is honestly one of the most fascinating contradictions in the entire defense tech sector right now.
Because if you just scan the headlines, Ondas looks like this unstoppable defense juggernaut.
Oh, for sure. The headlines are undeniably impressive. We are talking about record Q1 2026 revenue of $50.1 million.
Right, and management recently raised their full-year target to at least $390 million.
Which represents that massive 670% jump from the previous year.
And the contract wins are everywhere. You have tactical attack drones for Israel, U.S. Army orders, and even a counter-drone system deployed for the NFL.
Yeah, protecting the Jacksonville Jaguars at Everbank Stadium.
Exactly. So the narrative being sold to you, the investor, is a company that is just printing money.
But the reality of actually trading the stock requires looking way past that top-line momentum. I mean, the stock is currently trading around $9.77.
And it is wild, right?
Extremely wild. It carries a really extreme volatility profile. The beta is sitting at 3.0.
Meaning it swings 3 times as aggressively as the broader market.
Right. So our goal today is to strip away the flashy revenue numbers. We need to examine the severe underlying financial mechanics of this company.
To see if this hyper-growth story is actually creating per-share value for you, or if the underlying structure is, actively working against your portfolio.
Exactly. So let's start with the growth engine itself, because the capital flowing into the business is very real.
Yeah, Ondas is leaning heavily into this multi-domain defense strategy. They are super focused on counter-drone systems, which are often called CUAS.
Right, counter-unmanned aerial systems.
Plus autonomous drones, ground systems, and advanced sensors. And the demand for that hardware globally is just undeniable right now.
Oh, absolutely. That Q1 revenue of $50.1 million, that is a 66% sequential jump just from the prior quarter.
And their pro forma backlog is sitting at a staggering $457 million.
Yeah, and that backlog, that is the main anchor for the entire bullish thesis on this stock. But you really have to look at the mechanism that is actually driving that number.
Because it's not organic growth, is it?
No, not at all. Ondas didn't just invent a flagship product in a lab and slowly scale it up. They are operating a highly aggressive roll-up strategy.
They are just buying everything.
Pretty much. They have acquired over 10 different companies to cobble this portfolio together. Just in Q1 2026 alone, they closed acquisitions for Mistral and Worldview Enterprises.
And those layer on top of their previous major buyouts like Bird Aerosystems and Insight Sense.
Exactly. And here is the kicker. Out of that $390 million revenue target for the year, about $230 million is projected to come strictly from the companies they bought in just the first quarter.
That is wild. And honestly, it introduces massive execution risk. It is one thing to buy a bunch of companies, but it is another entirely to integrate them.
Oh, the integration is the hardest part.
Right. The visual I have in my head is like someone trying to build this invincible mega robot, but they're going to 10 different manufacturers, buying highly specialized toys, and just trying to bolt them together.
That is a perfect analogy. Ondas actually calls this their system of systems.
Right. But if you are buying a stratospheric balloon company like Worldview and then a tactical drone company like Mistral.
The software stacks are totally different.
Exactly. The data latency, the communication protocols, none of that naturally speaks the same language. So the question is, have they actually proven these systems can seamlessly share data in a live tactical environment?
The short answer is no. And
Yeah.
that is the absolute crux of the technology risk here.
They haven't proven it yet.
Not at scale, no. Despite aggressively marketing the system of systems concept since late 2025, management has not yet showcased a fully deployed, multi-platform integrated solution. Yeah. The logistical nightmare of M&A integration isn't just about meshing corporate HR departments, it is about hardware and software fusion.
Which is incredibly complex.
Definitely. When you combine 10 different tech stacks, which are often built on proprietary legacy code from different countries, getting an autonomous drone to hand off real-time targeting data to a ground-based jammer without a glitch.
It's an engineering mountain to climb.
Exactly. And militaries are not going to buy a fragmented, glitchy system. They need a unified dashboard.
Right. But to be fair to the bull case here, there is some significant third-party validation in the data that we shouldn't ignore.
Oh, for sure. Prime contractors are definitely validating the individual pieces of the puzzle.
Yeah, like Lockheed Martin. They are actively integrating technology from an Ondas subsidiary called Centrix.
And when a behemoth like Lockheed utilizes your tech, it removes a lot of the baseline technology risk for that specific component.
Exactly. Plus, Ondas secured a partnership with Palantir.
Which is huge.
Right. And that implies they are actively trying to solve that exact software and data integration bottleneck we just talked about.
Yeah, that Palantir partnership is crucial because Palantir's entire business model is fusing disparate data streams.
So the underlying hardware is validated by Lockheed, and they're bringing in software heavyweights like Palantir to help with the data layer.
Right, but, and this is a big but, the financial cost of operating this massive M&A machine brings us to the dark side of the balance sheet.
Because buying revenue is incredibly expensive.
It really is, which brings their cash flow statement into stark focus.
Yeah, if top-line revenue is exploding by hundreds of millions, you would normally expect to see some degree of operational leverage.
But the bottom line here is severely distressed. In Q1 2026, their operating losses widened to $42.7 million.
And to contextualize that for you guys, in the same quarter of the previous year, the loss was only $10.3 million.
So the losses are scaling almost symmetrically with the revenue.
It perfectly illustrates the friction of a roll-up strategy. Their operating expenses surged to $67.3 million in a single quarter.
Because when you acquire 10 companies, you don't just buy their revenue, you inherit all their bloat.
Right. You are suddenly funding duplicate HR departments, disparate IT systems,
Heavy amortization of intangible assets.
and the astronomical legal and due diligence fees required to actually close these deals in the first place.
Exactly. And even when you look at adjusted EBITDA, which strips out a lot of those one-time M&A costs, the losses still expanded year over year to $10.9 million.
They burned through $51.3 million in cash from operations in Q1 alone.
And this is where the financial reporting gets incredibly dangerous for retail investors who are just relying on basic stock screeners.
Oh, this part blew my mind. So if you pull up Ondas on a standard platform, the data shows a reported trailing 12-month net margin of 253.68%.
Which sounds amazing.
Right. And a positive earnings per share of over 41 cents. But wait, for a company burning $51.3 million in operational cash, printing a 254% profit margin seems mathematically impossible.
Because it is impossible, operationally speaking, it is entirely an illusion driven by mark-to-market accounting on their warrants.
Break that down for us because it's a textbook accounting distortion, right?
It really is. So, to fund this crazy acquisition spree, Ondas issued a massive amount of warrants. Warrants give investors the right to buy shares at a specific price in the future.
Okay.
But because of the specific terms of these warrants, standard accounting principles require Ondas to classify them as liabilities on their balance sheet.
Right.
And the value of that liability is tied directly to the current stock price.
So as the stock price drops, the theoretical cost of that liability mathematically decreases.
Exactly. And under the accounting rules, a decrease in a liability has to be recorded on the income statement as a non-cash gain.
Wow. So it flows through to the bottom line as if the company generated a massive profit.
Yep. But no actual cash entered the building. It is a phantom number reflecting a falling stock price, not operating efficiency.
That is so wild. Management themselves have guided that true company-wide adjusted EBITDA profitability isn't realistically expected until the first quarter of 2028.
Right, so that positive EPS you see on a screener, it's a complete mirage masking deep operational cash burn.
And that operational burn is what triggers the absolute biggest red flag in this whole analysis,
Yeah.
the structural dilution.
Yeah, this is the part that really hurts shareholders.
If they're burning cash, they have to raise cash.
Yeah.
And they're doing it by printing shares at just a blistering pace.
Looking at the capitalization table is honestly sobering.
Yeah.
In the fourth quarter of 2024, Ondas had 93.2 million shares outstanding.
Okay, 93 million.
By the first quarter of 2026, which is just 15 months later, that share count had ballooned to 469.1 million.
It's a five-fold expansion of the share base in just over a year.
Yeah, this is the exact mechanism that destroys per share value regardless of how fast the revenue grows. It operates identically to hyperinflation in an economy.
It really does. It's like a central bank aggressively printing new currency to pay for, massive infrastructure projects.
The bridge gets built, but your money is worthless.
Exactly. In Ondas's case, the revenue goes up 670%, but the money in your wallet loses all its purchasing power.
Because if you owned 1% of Ondas in 2024, by early 2026, your ownership stake was watered down to 0.2%.
Without you selling a single share, the market cap of the company could literally double, and your personal investment would still be deeply in the red because the value is spread across hundreds of millions of new shares.
And the dilution threat is far from resolved. The numbers indicate there is a $1.1 billion warrant liability currently hanging over the stock.
A $1.1 billion overhang on a company trading under $10 a share creates a brutal structural ceiling.
Oh, absolutely. Because we know how warrant execution works mechanically, right?
Right. If Ondas announces a major contract and the stock price begins to surge, those warrants move into the money.
The warrant holders execute them, converting them into common stock, and then they immediately sell those newly minted shares into the open market to lock in their arbitrage profit.
Exactly. The moment the stock gains any upward momentum, millions of new shares just flood the order book.
And that sudden massive increase in supply absorbs all the buying pressure. It forces the stock price right back down.
It creates an artificial lid on the valuation. The company basically has to burn through that entire $1.1 billion warrant overhang before the common stock can experience any sustained upside.
Which perfectly sets up the schizophrenia we are seeing in the market right now regarding sentiment.
Wall Street and retail investors are just staring at this fundamental paradox. Explosive top-line growth wrestling with massive dilution and a cap on the stock price.
And that tug of war is playing out across every single technical indicator we have. The divergence in market signals is extreme right now.
Yeah, the bullish camp is entirely focused on the government contracts and the macro environment, and the news flow certainly feeds that bullishness.
You have the multi-million-dollar drone deal in Israel and, of course, that big U.S. Army order.
Though it is critical to contextualize that Army order for you guys, it falls under a $982 million IDIQ contract.
Which stands for indefinite delivery, indefinite quantity.
Right. A lot of investors see that $982 million figure in a press release and assume it's guaranteed revenue.
But it isn't, not at all.
An IDIQ is essentially just a hunting license. It sets a ceiling for what the Army can buy from a pool of approved vendors over several years.
It doesn't guarantee Ondas will see even a fraction of that upper limit.
That is a vital distinction, and it's so often lost in the retail hype. Yet, analysts are still modeling massive upside.
Yeah, TipRanks shows an average price target of $19.57.
And Roth just initiated coverage with a buy rating and a $13 target.
So if you rely solely on those sell-side analyst notes, you would assume this is a deeply undervalued growth play.
But a lot of retail investors see a sub-$10 stock with hundreds of millions in projected revenue and mistakenly assume it's cheap.
When you look at the valuation multiples, the bearish undercurrents are completely justified.
Yeah, Zacks ranks the stock at number 5, which is their strong sell rating. They specifically call out the stretched timeline to profitability.
And when you check the trailing 12-month price-to-sales ratio, it sits at 54.92.
Which is astronomical.
It really is. The industry average for defense hardware tends to hover around like 1.8.
So investors right now are paying roughly $55 for every $1 of sales Ondas generated over the past year.
Even with the forward revenue projections baking in the recent acquisitions, that valuation is priced for absolute flawless execution.
And the people who know the most about that execution risk the company insiders. They are actually reducing their exposure.
The insider selling is a very quiet but consistent alarm bell. Over the past 90 days, insiders have sold a net 1.86 million shares.
It's not a complete mass exodus, but when management is selling into a deeply compressed stock price while simultaneously pitching a huge turnaround narrative to the public, you have to pay attention.
Absolutely. Because of that massive insider selling and the warrant overhang we talked about, the market is essentially paralyzed right now.
It cannot reconcile the revenue growth with the cash burn.
And you can see that paralysis perfectly in the technicals and the price action over the last 6 months.
The chart is entirely deadlocked. It rallied hard off a 52-week low of $3.20, peaking at $15.28 back in January 2026.
But since then, it has completely stalled out. It's consolidating sideways in a very tight $9 to $10 range.
The year-to-date return is essentially flat. The market has basically called a timeout, and it is waiting for a definitive catalyst to break this tension.
And that catalyst is rapidly approaching. The ultimate near-term proving ground for this stock is the Q2 2026 earnings report.
Right. Management has explicitly guided the market that Q2 will represent the peak for their adjusted EBITDA losses.
So Q2 is the promised pivot point. This is where they have to prove they can generate operational leverage.
Exactly. If the Q2 report confirms that losses have indeed peaked, and they project, those losses will narrow sequentially in the second half of 2026.
While revenue still tracks toward that $390 million target.
Right. Then it validates the entire roll-up thesis. It proves they have finally integrated the back offices of these acquisitions and stopped the bleeding.
But if they miss that guidance, if operating expenses climb again in Q3 and the cash burn accelerates, the whole narrative collapses.
Because the re-acceleration of losses means they will inevitably have to print more shares just to keep the lights on.
Accelerating the dilution cycle all over again.
Which is exactly why the options market is pricing this as a severe binary event.
Yeah, the implied volatility suggests options traders are expecting an 11.14% move in either direction solely based on the outcome of this upcoming earnings report.
The tension is coiled incredibly tight.
It really is. So, pulling all this data together, what is the final verdict from the analysis on Ondas right now?
The quantitative verdict we are looking at gives it a solid rating 5.
Which is neutral.
Effectively a wait-and-see stance. For you as an investor, the clear takeaway is to monitor the fundamentals rather than taking a directional bet based on headline momentum.
Because the demand for counter-drone technology is robust, the top-line revenue reflects that reality perfectly.
But the per-share value proposition is severely compromised by unproven technological integration, a massive cash burn rate, and a $1.1 billion warrant overhang.
Yeah, you do not want to step in front of that structural dilution until management conclusively proves they can operate this system of systems profitably.
The prudent move is to let the Q2 earnings report confirm that losses have peaked before committing capital.
So to quickly recap the core dynamic for you, Ondas is executing an aggressive, acquisition-fueled defense tech roll-up.
They have secured incredible top-line momentum and validated their technology with prime contractors.
But they are financing that growth with staggering cash burn and brutal shareholder dilution.
It's a high-stakes binary setup heading into their next earnings release.
That encapsulates the financial reality perfectly. However, before we sign off, I think it is worth zooming out to look at the broader macro picture.
Oh, definitely. Because the geopolitical landscape might introduce a completely different set of rules for companies like this.
Right. The macro tailwinds are impossible to ignore right now. We are firmly in an era of rapidly escalating NATO defense spending.
Autonomous drone warfare and the counter systems required to defend against it, they are no longer just speculative R&D projects.
No, they are urgent existential necessities for militaries globally.
Exactly, and that urgency forces us to ask a really difficult question about how defense markets operate long-term.
So here is a final provocative thought for you to ponder on your own. Given the sheer desperation of global governments to stockpile these specific autonomous technologies,
is it possible that the urgency of the military-industrial complex will eventually bail out heavily leveraged, high cash burn hardware companies like Ondas?
That is a fascinating angle. If the geopolitical threat level is high enough and the government keeps writing blank checks to secure the supply chain, the traditional physics of the stock market might actually bend.
It makes you reconsider the standard financial metrics entirely. Maybe it doesn't matter if a company's balance sheet is a mess and its shareholders are diluted in the short term.
As long as the Department of Defense is the one strapping the booster rockets to the hull.
It's the ultimate tension between textbook financial fundamentals and harsh geopolitical reality.
And it's exactly why tracking defense tech roll-ups requires looking way beyond the spreadsheet.
Absolutely. Well, thank you for joining us today. Before you go, remember to check out that Stock Oracle 14-day trial link in the description to explore these AI insights yourself.
Just remember to verify the data, as it is a research tool, not financial advice.
And as always, if you found this useful, please subscribe, like, and comment underneath. Keep questioning the mechanics behind the headlines. Always check the share count, and we will catch you on the next one.